Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer of Financial Enhancement Group, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. And here for this March 24th Market Carver, next to the last one for the first quarter, believe it or not. On today's agenda, we're going to hit a few items here. We're going to start and talk about the Fed, which was at a pivotal meeting because we went into an interest rate hike phase. We knew that was coming, but now we're officially in that regime. We're going to talk about what had the potential to be a very, concerning headline about the Saudis being willing to trade outside of dollars for their oil barrels, and we'll give our 2 cents on the potential significance there. And then the S&P 500, the daily chart that Andrew's been keeping us posted on week in, week out. And then lastly, fertilizer prices amidst one of really an inundation of food-related cost charts. So we'll talk specifically about fertilizer. So before we get into the topics there, Andrew, anything you wanted to say or share to the audience that maybe we didn't have in the charts?
There could be a whole litany of list of things, but I think they try to keep this video less than 3 hours, so I won't start opening up that bag.
Fair enough. And Lord knows, based on our investment meeting yesterday, we could spend quite a bit of time on this next topic, the Fed. You can really drill into the heaviness there, and we'll try to keep that as light as possible. So this is a vague chart with a lot of different dots, but it is perhaps the most significant thing the Fed releases in their projection. So to keep this very simple, each little dot here represents a voting member of the FOMC's projections of where the Federal Reserve's interest rate policies will be at the end of 2022. And we have them listed here for various dates, going all the way back to September of 2019. Not really relevant. That was when we were in a normal environment. Then, of course, we went down to zero from 2020 through 2021. And then gradually they began to raise the expectations of where interest rates will be. The red line and the red numbers indicate the median. Where is the middle? And that's really the focus, because you're always going to have some that are more what we would say hawkish and expect those rates to be higher. Those are the dots above the red line. And then the blue ones are the doves, those that expect to keep policy lower. You don't really know which members are which dot. It doesn't really matter. What matters the most is that median line. And so late last year, we began to gradually get notification that those dots were moving higher, that the rates by the end of 2022 would be up there. And finally here at this March meeting, we got them raised all the way up near 2%. So we've got the first rate hike of 25 basis points or 0.25% in the books. And the expectation at this point was for 6 more. So we are very well underway for those rate hikes. A little bit of confusion that I would add. I was sharing with Andrew real time, listening and studying these numbers when they came out. It was a little odd. And if I could summarize it, it was that the Fed is kind of hopeful, a lot of wishful thinking in their projections, which they're in a better seat than I am. It's just sometimes you want to plan for the best, plan for the worst and hope for the best. And that was in a lot of their projections. So there was some concern there that they really weren't grabbing hold of the gravity of the inflation situation and willing to tackle it. I say they've cleaned up a lot of that dialogue early this week with Powell commenting on some of his take. And specifically what that means is now there's the more realistic view that they will have to go pretty aggressive and do half a point or 50 basis point hikes in the next 2 meetings. So very seriously, we're in this interest rate increase environment. We at Financial Enhancement Group, there's nothing I say to you guys that you have to be aware of. We fully are prepared for this. We've been very defensive where interest rates are provided, and are actually we'll be on the lookout to find potentially some chances to take advantage of those rate spikes as they come, because there's certainly been a forceful reaction to that. So that's really all we need to spend on the Fed. We're going to move to some more technical oriented data and sets. But first, we'll talk about this scary headline, Andrew, of the Saudis, which have for decades traded their barrels of oil for dollars. And amidst this conflict with Russia and Ukraine and question marks about where China stands and what they will not do, the Saudis have at least said they're open to trading their barrel barrels of oil for yuan, the Chinese currency, instead of dollars. So that got a lot of people's attention, and just some of our thoughts. The dollar is by and far the world dominant currency, right? It's 88% of the Forex market, the forward exchange market. The world needs dollars, and the Chinese yuan is 4%. That is a dramatic difference, and it's in nobody's interest for that to change very quickly, especially, I would say, the Chinese, who have for a long period of time wanted to keep their currency depressed. So that's really the long and the short of it. Long term, we don't want to pretend to know exactly how this will take shape. We've had many different global currencies through time, and I would expect over the very long run for that to continue. But Andrew, you had some interesting points, and I don't want to cover them all. I'll let you convey the great points you made on this yesterday as well.
So kind. Thank you. Yeah, we're seeing this headline come up a lot, and it's not a new headline. This is something that gets talked about several years ago. Anytime that oil kind of enters the picture, when oil prices go up, it seems this headline gets trotted back out. What if Saudi Arabia or anything, the dominance of the U.S. dollar, and one of the main dominants for the dollar is the fact that the commodities are traded in it, and that Saudi Arabia sells oil in dollars. Something that people might not realize, that Saudi Arabia has their currency pegged to the dollar. What that means is it basically it moves with the dollar. And so by decreasing the volatility of their currency because it's pegged to the dollar, and there's other countries that do that as well, that's not unique to Saudi Arabia. If they were to break away from that and start transacting oil in other currencies, that's going to have a big issue, essentially, where if they were to sell their oil for yuan, they're going to convert that money essentially back to US dollars. So there's really not a big point. The second caveat there is, imagine if you were to sell your house, and instead of someone paying you in dollars, they paid you in Walmart gift cards. Well, now what are you going to do with those Walmart gift cards? All you can do is go to Walmart. That's the same thing as if Saudi Arabia were to start trading in just one other currency. They get those yuan, but then all they can really do is then transact in the Chinese economy. They could buy Chinese bonds and things like that, but it doesn't provide them the ability to then convert those again. They have to convert them back to US dollars to really use them, because the US dollar, as this chart shows here, is such the primary currency for trade. What this shows here is that 88% of basically trade volume in 2019 was transacted in US dollars. And so the Saudi Arabia primarily wants to keep every transaction in dollars so they can continue for their economy. The third point I'd make there is there's often a discussion of what if we went to a basket of currencies. The issue you have there is it introduces, again, volatility back to their economy. Because they're pegged right now to the dollar, any type of move away from that, when you bring in other currencies, it brings with it volatility. And that's not something Saudi Arabia wants to do right now as well. We also don't want to forget Saudi Arabia is kind of in their own little skirmish right now. They're getting attacked. They're having issues from I believe it's the Houthis. I'm probably pronouncing that wrong. But again, they're having their own kind of conflicts going on right now outside of what's going on with Russia and Ukraine. And so I don't think they want to start kind of ruffling any feathers by breaking away from that dollar peg. So again, like Adam said, it's a scary headline. We don't think it's one that's going to be to come to fruition. And that's kind of our 2 cents on it.
Yeah, excellent. So we've had switching out of stocks. We've seen a nice, strong rebound, and now it's time to take stock and put that in context of where we're at in your daily chart that you've kept us up to date with, and we'll continue to do until we kind of have a new trend resolved.
Yeah. So I tried to clean up this chart a little bit, took off some of the busyness from the last time we showed the S&P. But like Adam said, we had a nice, strong last week, a really strong 4 days. We're recording this video on Tuesday. We're having so far a strong start to the week. There's still a lot of headlines, still a lot going on with the Fed and what's going on in Russia and Ukraine. So this very well maybe look like a different picture by the time this video rolls out on Thursday. But we're starting to see momentum start to pick back up. You can see on the bottom panel of that chart is a momentum indicator. It's starting to make higher highs. That's a good thing. On the price portion of the chart on the top panel, we're getting back above the key 50-day and 200-day moving averages. That brings a lot of confidence to the market, primarily getting back above that 200-day moving average, which is kind of right where we closed, where we stopped trading last week, getting it back above it so far the early part of this week. We'd love to see that get a close, several closes above that level as we finish out this week, finish out the month and quarter. There's still a lot of work to be done below the surface. We still have a lot of stocks still kind of going down. We still have a big drawdown from a lot of individual equities. that need to be resolved and improved upon. But from an index level, we are seeing kind of a bounce here. Hopefully we can get some continuation, but we're still kind of in this downtrend. Our models still have us qualified or classified as a downtrending market. Maybe that will change if we keep going higher this week, but we'll take it one day at a time.
Excellent, sir. Thank you very much. And last up is a topic that I will say you were very early in pointing out. And we got to look at it from a few ways. The first is just the pure humanitarian element of it. Okay, the food situation around the world is not a good one. And we do certainly have concerns, especially for those less food secure countries. But fertilizer prices were one of the things that you pointed to early for being a potential concern for this year. And as you highlighted, this week, it's the news is not really good. It does, on the other hand, the other aspect has given us some opportunities within the portfolio. We definitely have some exposures in the portfolio that have benefited from this. But I'll kind of let you take over the implications and the new marks we've made.
Yeah, without going too far down this rabbit hole, as I said earlier, could spend probably 3 hours talking about some of this stuff. But fertilizer prices are a big concern. We started talking about fertilizer last year, just as the kind of the crisis that was going on, the energy crisis in Europe, and we were starting to see fertilizer prices go higher as natural gas prices were going higher last year. That's not only been exacerbated with the conflict in Russia and Ukraine. Russia is one of the primary providers or exporters of fertilizer and the ammonia and things that go into that. And so as they are discussing kind of banning some of the exports, or just the fact that it's very hard now to get a lot of that out of Russia, is causing fertilizer prices to go even higher. We're seeing reports that farmers in Iowa are paying 3 times what they were paying last year for fertilizer. Globally, there's been a lot of issues with some of the supply for crops as we start getting into planting season. And just seeing a lot of countries are starting to ban exports or trying to kind of put up guardrails to protectionist policies for the commodities market. And that's going to, like Adam said, could have a very big impact if it continues on that path for some of the third world countries or countries that maybe are heavily reliant on importing a lot of their commodities. And we're seeing this not just from, think corn, wheat, soybeans. We're seeing it in milk. We're seeing it in livestock. We're seeing it in pigs. Kind of across the agricultural board, and then flow into as well as metals and energy, just kind of all commodities in general, really having some supply shocks on the supply side. And the cost of fertilizer is really, again, just kind of making that worse. So we're continuing to watch fertilizer prices. We think these are going to be costs that are going to be really hard for farmers to digest, and are going to continue to have implications for the commodity market, and why we think that we'll continue to see commodity prices stay elevated for a good chunk of this year, outside of some other input that changes, whether we have really, really good weather, hopefully we do, or the kind of the issues in Russia and Ukraine get resolved, and we can start getting the flow of fertilizer back out to the global farmer.
Very good. Very good. Appreciate that. That's all good stuff. As usual, I do want to say we're heading into thirdly season, so hopefully we get a chance to see you all come out here at the various locations through April. I think we kick off the first week, April 5th or 6th, one of those dates in Anderson. So hope to see you there. If not locally, then virtually, one of the two. And also don't forget, you can call to schedule your meeting, 800-928-4001. Scan the QR code if that's your preference. And then lastly, our weekly radio show, a reminder to catch it WIBC over the traditional airwaves or however you get your podcast. So thank you for spending a few minutes with us, and have a great weekend.